Hi, and welcome to our LinkedIn Live broadcast on the release of the ISM Manufacturing PMI Report. I'm Dan Zeiger. I'm a senior writer and editor for Inside Supply Management. That's Institute for Supply Management's member publication. And we're glad that you've joined us as we break down the manufacturing PMI for March. New orders and backlogs growth slowed as exports contracted, but production strength helped boost factories in March. The manufacturing PMI ticked up to 52.7%, which beat analysts' expectations, despite headaches from tariffs and the Middle East conflict. If you were with us last month, we noted what both of those developments might mean for the prices index, which had already taken a sizable gain. And for a second straight month, that index hit its highest reading since June 2022, when it was 78.5%. But in March, it got a lot closer. It was up 7.8 percentage points to 78.3%. That's one of the top things we will discuss today. Many things to discuss today with Susan Spence. She is the chair of the ISM Manufacturing Business Survey Committee. Sue, you may know that old saying about March, and I'll play off that as my first question to you. After looking at the data for March, what do the thoughts of the Manufacturing Committee chair turn to?
Thanks, everybody. Welcome. It is an interesting time to be the chair of the Manufacturing Committee. I know I say that often. It got more interesting. The 52.7 was a bit of a relief. What was not was the third month in a row of that growth declining, at least for the key sub-indexes that make it up. So, we lost ground with new orders. We lost ground with backlog, about the same amount, about 2.3 down. So while we are still in expansion and production makes sense to me that it ticked up even a little more. Think about the analogy of the python eating the mouse. Sorry about the disgusting analogy, but the lump of new orders is moved through, down to production backlog. We need the new orders to stay at least where they are and not deteriorate further so that we don't tip back into a contraction. So that's my worry this month, and we'll get to the Middle East conflict in a minute. If you look at the indexes that make up PMI, inventory is still in contraction. Employment is still in contraction. Production looks pretty good, but again, I think that's a really knock-on effect of the new orders that has been up for the last 3 months. So my feeling is that unless new orders stay at least where they are, if they decline much, much further, and then production will follow a decline, then I think we could tip back in. We talked about prices, and I'm glad you mentioned highest 2-month run up in 4 years. That's exactly right. Our survey was out when the Middle East conflict started. I feel certainly that the sentiment, which we'll talk about in a minute, is reflecting those new concerns on top of, the continued concern about tariffs. I'm not certain the numbers are reflecting it yet. We'll see if that happens next month. But, prices up and employment kind of stagnating, being flat at best. Those are the two things the Fed's watching to try to keep in balance. So not going the right way for either. So if you think back to the semi-forecast in December, our panelists did say they thought there'd be a manufacturing revenue increase of about 4%. If the Middle East conflict hadn't broken out, is the question I'm getting today. Do you think we'd be in better shape? I think we'll know the answer to that next month, either because it's still going on or maybe there's some impact. I'm hoping it's short-lived, and we still have, unfortunately, some uncertainty with tariffs as we wait for the next round and replacement to IEEPA happen.
Yeah. Well, let's camp there a little bit, because I know it was the focus of a lot of questions of earlier interviews that you did today, one of them in particular that I listened in on. And you stated it in the report as well, the tariffs and, the lingering issues there and the hostilities in Iran and other parts of the Middle East. Those were definitely top of mind for the panelists in March. Discuss the supply chain implications. How have they intensified or evolved since we last convened?
If you break out, let's talk about sentiment for a moment. We had much worse sentiment in the late summer early fall than we do now. Back then, for every positive comment, there were over 6 negative, and at one point, 80% of our panelists mentioned tariffs in their negativity. We're down to every positive comment, there's 2.5 negative comments. It is much improved, and we have about 20% of the comments mentioning tariffs. That's much improved. IEEPA Supreme Court ruling has helped. What would really, really help, and I've been saying it all day, is if we can get trade agreements like from what I'm reading, the EU is voting to approve their 15% tariff deal with the US, but with protections for them, including if they're treated badly. And they cite Greenland as an example. They want the right to put all those on hold again. My feeling is if there can be tariff agreements that sit maybe no worse than 15% and that people feel they're going to be not overturned with the next round of leverage or negotiation, then you're going to have a little more stability and people being more comfortable ordering goods, and then everything gets better. The Middle East conflict, depending on how long it lasts, certainly will impact prices. Has it impacted prices yet? Possibly. Those are pretty immediate in, the industries that depend on petroleum, certainly. But I feel like we're getting into a better trajectory because uncertainty was maybe starting not to be completely put to bed. So this additional shock, as one of the reporters called it, on top of the chaos and uncertainty that still remains because of the policy of, all right, we just got to go find more tariffs to replace the first ones. That is, as our panelists said, causing them to just be very careful, not make any sudden movements with capital investments or big hiring waves. So we still have that going on. I do hope we see next month when we come out with our semi-forecast the same optimism that our panelists had in December about what's going to happen this year. We'll see.
Yeah. Well, obviously prices was the index that people were looking for based on the last activity last month. And it was one of the most eye-popping, if not the most eye-popping reading today. 78.3%, as we said in the intro, highest reading in nearly 4 years. And as you pointed out in the report, you do the math and it's increased 19.3 percentage points in the last 2 months. Most interestingly, 24 commodities were reported as up in price and none, 0, were reported as down. So discuss that that menagerie of frustration, I'm sure, for purchasers and supply chain people.
Yeah, and if you look to page 8 of our report, folks, just look at the change from December. The price index in December was 58.5. It nudged up to 59. Okay. It leapt to 70.5 and then it leapt again to 78.3. That's an amazing run up. And as you said, 24 commodities up, none down. Likewise, 17 sectors out of 18 up. The only one that's down, printing and related support activities, which is a very small portion of manufacturing sector GDP. So everything's up. I am imagining that the Middle East crisis has probably impacted that more than the other indexes have been impacted. And again, you've got the petroleum products. And even though, the U.S. doesn't depend as much on the Strait of Hormuz as most other countries, it's still a worldwide index that's set, Brent, right? And we have West Texas Intermediate here. So it's going to affect us, and it already has. You see it at the pump. And so it is impacting things, and it will continue to be, as I mentioned before, a shock on top of already chaotic conditions. Hopefully that's going to, I won't say be over, but hopefully that's going to lessen. But it could very well take a toll on our forecast. We're going to see. And it's all up to what the customers decide to do. One of our panelists, transportation equipment, they always have really insightful quotes. And they talked about people are replacing and not growing their fleets. They're doing the minimum of what they have to because you still have the, pricing shocks from the tariffs and you don't know what's coming next. And now energy costs just got worse for everybody. And then there's some commodities that are really dependent on that area.
Yeah. I had a quick question about the demand indicators that we discussed a little bit at the beginning. I'll hold off on that because you had mentioned the comments. And yeah, I totally agree. There were a lot of good comments in the report. And I know you and I have had fun with them on this broadcast in recent months, because some of them have been kind of venomous or biting. But, I didn't think that was a lot. They were just insightful this month. And here's one of from a survey respondent in chemical products. It's rather lengthy, so bear with me. He or she wrote that ongoing geopolitical instability has emerged as a persistent factor influencing global trade dynamics. We anticipate strategic realignment of supply chains as organizations respond to energy market volatility and shifting trade policies. In light of these macroeconomic headwinds, we, like most organizations, are maintaining a cautious posture regarding investment commitments while continuing to monitor market conditions closely. Our purchasing strategy is being recalibrated to address supply chain vulnerabilities exposed by energy market volatility and evolving trade protectionism. I mean, we've heard talk like this for a variety of reasons, especially since COVID. I don't think this is overstated. I mean, are we, seeing another dynamic that, is necessitating a shift in philosophy or approach in terms of sourcing?
I don't think it's overstated. I think we got to believe people when they tell us this is what's happening.
Yeah.
And, this month marks 1 year for me anyway, where I accepted the position and started learning about really what goes into the report, which is fascinating. But, think about everything folks have had to deal with. And one thing we've said about our 18 sectors and our wonderful variety of panelists across those sectors, there's patterns. And so if you're dealing with chaos from tariffs and you're dealing with it by country and in some cases by commodity, steel, aluminum, and then you have that maybe settling down a little with at least understanding certain tariffs aren't going to be allowed now, according to our Supreme Court. But then you have this Middle East conflict and all the energy. And so you can try to adjust and recalibrate your supply chain strategy and vulnerabilities. But when I read that, and I love that comment because it was insightful and very detailed, where else can you go? What else can you do? And we'll be talking about that at the conference because there's no easy solution. And I can imagine some of our panelists feel no matter where we turn, we're hitting a wall because here's the next thing and the next thing. And all that is the chaos, the uncertainty. And, look at what they talk about in light of these macroeconomic headwinds. We're maintaining a cautious posture regarding investment commitments. I consider that capital and also hiring people.
Sure.
So you don't know what's happening with your pricing because you have tariffs. And now you do know what's happening with your pricing for the energy sector, meaning your transportation, anything that's made, think chemical products, right? Really, a lot of petroleum based, right? And so now you've got that headwind on top of it, along with the uncertainty of the next round of tariffs that are going to go on. You're still not going to probably spend your capital. You're probably going to reserve it in case you have to boost your profit margin for some companies. And you're going to make do with the people you have because you don't want to hire, train, and then have to do layoffs. And we haven't even started with AI, which I don't think is prolific yet in manufacturing. But, as business owners and leaders of these companies, it's not great, even though we're having a bit of a run up into expansion. So again, I'm paying attention to what these same panelists say about their forecast. But I'd love for it to get better, but I feel like everything's working against these folks. And luckily, we still inherited a year and a few months ago a pretty strong economy, and we've weathered it better because of that. But, we don't want to be sitting in the high 40s, right? We don't want to be below that, but we want 50 to go to 55 to go to 60, and everything's got to be moving in the right direction for that.
Well, yeah, that's a good segue because let's talk about that. I mean, there were some indicators, we're not, ISM traditionally does not read more into the data that is there, that lets the data speak for itself. We're not going to scream that, there are red flags here, but there were some yellow flags. As we pointed out in the introduction, new orders, backlogs growth slowed, exports contracted. The production was good. We pointed out that was because of those demand indicators looking good the last few months, but eventually you got to have something to feed into that. I'll give you the number, up 1.6 percentage points. I'm talking about the production index in March to 55.1%. Panelist sentiment in that area was positive. So discuss that. But I mean, obviously a good number, but I mean, if you don't have orders and activity feeding into that, that's not going to stay up for very long. Just discuss that. Kind of a two-part question, but let it rip.
Yeah, no worries, no worries. So our surveys are answering this month relative to last month: better, same, worse. Which is why we want our audience to pay attention to the semi forecast, because it looks out longer. But what's great about doing this report and publishing it every month is you're not just looking back 3 months for the last quarter, for like an earnings call we'll do, for the stock market. You're saying, here's what's happening pretty real time. And so if there's going to be a demand shock because of a conflict in the Middle East that affects a lot of sectors, or these tariff, negotiating levers or threats, or however you want to characterize it, you're going to see it in the data pretty quickly. So we certainly, we don't want to say that new orders and backlog are taking a dive. They're not, but growth slowing down and heading back toward 50 means that you're going to, as you said, you're going to see that in production probably within a month or two. So the question is, what is going to happen to get those orders back up? More certainty, customers feeling comfortable and feeling like it's in their best interest to order more than a month worth to fill my shelves again, or, replace my fleet versus grow my fleet. What I love about the transportation equipment sector, and, certainly I worked in transportation logistics when I was at FedEx, you see stuff there first. If goods aren't going to be moving, and that's leading to contraction, you're going to see it first in the shipping and logistics information, and then that industry has to order replacement trucks and ocean freight, rail cars, and things like that. So I pay particular attention to that because it's a leading indicator of maybe where the economy is going, and I pay a lot of attention to chemical products because it is the biggest sector of manufacturing, and it's in so many things, and frankly is really impacted more by the goings on of the crisis in the Middle East and oil. So we are not trying to predict, but we're kind of trying to say, all right, if these variables are going on and they're doing these type of patterns, is that a good sign? Is that something that we could kind of warn about, to say, ooh, last time that happened, here's what the result was. So the data matters. You can also be paralyzed by analysis, which is why the data is great, but the comments really inform that. Here's what's going on.
Yeah. You alluded to this earlier when we were talking about that comment about investment in returns, not only in terms of capital, but also hiring. That's a good time to bring up the employment index. The JOLTS data for February, it came out yesterday, lowest rate since April 2020. That was in line with estimates, so markets kind of blew that off. The ADP report today was somewhat positive. Or expected. Our employment index decreased slightly in March, 48.7%. Among companies surveyed, 14.2% reported increasing staff, down from 18.8% the previous month. Good news, 70.8% had the same head count. That was up from 60.8% in February. Kind of sounds like things are stuck in neutral. Is that the best way to do it?
I would say so. Yeah. And, our panelists saying, hiring versus not hiring, low hire, low fire is still how people are describing the economy we're in. So for every positive comments, I'm hiring, 1.2 panelists saying we're not. So it makes sense. Some of the data you talked about. Also, I look at initial and continuous jobless claims every month. So this month in March, initial jobless claims for the week I looked at, it was at 205,000. It was at 206,000 last month, and continuous claims was at 1.857 million. It was at 1.87. So it's flat, and it makes sense because, again, I'm not hiring, maybe I'm not firing, laying off. I'm standing still because I'm not sure what's going to happen. Is this, 3-month uptick in new orders and 5-month uptick in production going to hold or not? Well, I could probably wait out and try to do the work with the same number of people versus, like we said, making an investment that may not pay off because things might go back in the trough. So it's good. It's not worse. And we'll call it flat, even though we're down 0.1. My fear is that it will go in the wrong direction if the production, because new orders and backlogs start to head back down.
Yeah. Well, another index that kind of stood out this month was supplier deliveries, which is appropriate because, we get a lot of questions, about how that index works from time to time. So it's a good time to revisit it. Hit 58.9% in March. That was the highest reading since May of 22, 65.7%. It's inverse. So a higher reading means slower deliveries. And when that index goes up, it tends to reflect, higher demand or supply bottlenecks. I mean, the demand numbers in recent months have looked good. And obviously we've talked at length about what's going on in the Middle East right now and, the supply challenges there. So was that reading maybe a product of both dynamics a little bit this month?
Yeah. I'm gonna assume you're probably right about that. Yeah. What's interesting, it's the highest since 22, but our demand indicators aren't the highest since 2022. So that tells me it's not a straight line, I guess. But if they're busier or slower with their deliveries, perhaps in the last few months they're a little busier. The question is, would the conflict in the Middle East have hit this quick? Well, it depends on the sector, right? It's interesting because supplier deliveries is one of the indicators that make up PMI. So when that's a high number, it kind of boosts the PMI. Well, if supplier deliveries are higher because of a choke point in the supply chain, then it's almost a false sense of security with a higher PMI. So again, that's one of the things you could drive yourself nuts, pulling numbers out, put them back in. We'd love for it to be higher because they're busy, because orders are up, and they are, but they haven't been up for that long. Right. Yeah. And, if you think about shortages, right? So we have 24 commodities up in price, none are down. And the shortages, I think there's a typical number of shortages, 1, 2, 3, 4. We got 6 or 7 shortages, including memory, semiconductors, electrical and electronic components, except for bearings and rare earth. Except for bearings, those other commodities that are short, my brain goes to data centers and big build out and these, hyperscalers, as they call it. Well, again, except for bearings, unless it is bearings that might go in the build, these other areas seem to be, it's a competition for building those up. So, perhaps that's it. Or, perhaps some of these flow through the Gulf. I don't think that impact would be that soon.
Well, Sue mentioned she's going to be involved at the ISM annual conference later this month in Denver, and that session, given current events, seems to be becoming more of a must attend by the week, it seems. But she and Steve Miller, the chair of the Services Business Survey Committee, will host a session on how the ISM PMI reports can help a company's business decisions in areas like forecasting, planning, risk management, more. ISM World 2026 is April 26th through the 28th in Denver, and you can get more information at ismworld.org/conference. So given that and what that session is going to be about, we can kind of have a mini session right now. Sue, if I'm a CEO or a high executive, what can I take away from this data and how can I make it work for my company?
So I'm going to give a little tease to Steve and and my talk. There are no quick fixes. I'm sure they're very, very smart people in this profession already probably doing most of what they can. We're going to try to focus on things that are longer term strategies that you should do regardless of whether there's tariff chaos or a war, because it's good business. And that is trying to mitigate risk that is inherent in your supply chains. And so tune in for that. It is something I personally learned to do in my first 6 months at FedEx when we had a major impact with disruption of our fuel supply. And if you're an airline or a logistics airline and you can't fly, you're kind of done. So I want to get into a little of that versus having time here to do it. But it's great planning. It's things that you could do to try to survive disruptions. It doesn't prevent them. It helps you survive them. And it's about not throwing millions of dollars at software, and, spending all your time and money on data, but really kind of thinking through what can shut you down. So that is my little teaser. Join, call in, or, publish. We'll publish it, I'm sure.
Yeah.
Looking forward to it.
Yeah, well, it's one of those days where we got a lot to talk about, and I wish we had more time, but we are reaching the bottom of the hour, and I know you have another interview at that time. So I'll just wrap it up, or, ask you to wrap it up by, is there anything that we haven't discussed or anything that I haven't asked that you think might be important to include for our viewers before we say goodbye?
I think we covered it all. Stay tuned to the news, of the day. I hear there is a 9 o'clock press conference from the president tonight. It's a fast-changing world, fast pace, and appreciate everyone working very hard to keep their supply chains flowing and going.
Yeah. Well, hey, Sue, thanks a lot. We appreciate your time, and we'll talk to you this time next month. Sure, will be interesting. So thanks to you also for joining us today. In a bit, you can go to ISM's website to read the roundup article that details a lot about what Sue and I have discussed here. A programming note, Friday is the third business day of the month, and that's usually when the services PMI comes out. But of course, it's also Good Friday, and the New York Stock Exchange Group markets will be closed that day. So as a result, we'll see you for the services PMI report for March when that's released on Monday. Join us then when we break down that data with Steve Miller, the chair of ISM Services Business Survey Committee. And if you want to be a part of the ISM Manufacturing or Services Business Survey panels that help compile data for the ISM PMI reports, visit ismworld.org/join the panel for more information. So for Sue Spence and the people who helped us behind the scenes today, their names are Christina Cahill and Jennifer Stevens. I'm Dan Zeiger, and we'll see you on Monday.